My name is Peter MacIntosh. I'm a partner with White Kennedy LLP. I'm a chartered professional accountant, and I've been in the accounting industry since 1996. Clearly, with the last several federal budgets, there's a policy objective with the government to create incentives to facilitate charitable giving. One of the main tax benefits, which a lot of people know about, is the donation tax credit. It's a tax credit, so basically it's a savings right off your tax bill. You know, in real world numbers, if you were to make a $1,000 donation, if you factored in the federal tax credits and the provincial tax credits, the true cost of that donation to an individual is only $620. So that's a good way to think about the charitable giving and the tax benefits related to it. It's calculated with 15% of the first $200 of donation and 29% of any donation in excess of $200. There is a cap or threshold on how much you can donate each year to 75% of your net income, but you get to carry forward any excess donations that you don't use for 5 years. In the year of someone's death, you can actually make donations up to 100% of their net income, and you get to carry any excess back to the previous tax year. A lot of this information can be found on Canada Revenue Agency's website, but my suggestion is actually to speak to your professional advisor, your accountant, and understand the rules so you can use them to your benefit. The first time donors super credit was created in the last budget. It was basically an incentive that was created to get people to make charitable donations if they haven't made any kind of donation in the last 5 years. What it does is it basically adds 25% to the donation tax credit rates, the existing rates. So instead of 15, the first 200 would be 40, and any excess would be 54 instead of 29. There is a $1,000 limit on the amount of donation that this applies to, and it also has to be a cash donation. But once again, it's just an incentive that the government has created. The donation tax credit has to be shared between spouses. One thing I would like to mention is that if I were to hazard a guess, I would say that this is probably a temporary measure, and people would want to take advantage of it as soon as possible. A simple way to meet a charitable objective with insurance is to name a charity as a beneficiary of a policy. Your estate would get a full donation tax credit for the death benefit of that policy. Another unique area is perhaps donating an existing policy that you may have. You would get a donation tax credit for the cash surrender value. As well, you would actually get annual donation credits for the premiums that we can continue to pay over the years. So there's some interesting areas that and planning opportunities that can be explored. You know, I would say I'm not an insurance advisor, but you know, you could deal with a knowledgeable insurance advisor and they could steer you through some planning options there. You know, the main point that I'd like to make is that there's lots of planning opportunities. You know, if someone has a charitable objective, there's lots of planning opportunities available, and it's important to you know, discuss them with your professional advisors, understand the rules. By doing things in slightly different ways, you know, you'd be able to meet, number one, your charitable objective, and number two, once again, maximize these benefits to yourself and to your estate.